Day two. Day one clearly was not too difficult. You just had to sit there and watch me cry like a little bitch. But here we are, day two. We're actually looking at
God
charts.
damn,
But
Hilo.
you probably won't learn much again because this is going to be a video from scratch. But you will gain, or sorry, this is going to be a course from scratch. But you
Motherfucking
will
loud
gain a
as
couple things. I'm
fuck.
going to toss in some little tips that you
Shit.
probably didn't pick up when you were a
Shit.
beginner, that can help you along the way. So today we are going to be talking about candlesticks and price movement and understanding price movement within candlesticks. Okay, so
I do have a notebook, an empty notebook page right here. Can't really see because if it glares, nothing on it. Nothing on it. Well, maybe some besides some dirt. But then I got me interesting. But alrighty. I already know what candlesticks are. I mean, I'm doing this for me, so I'm not doing this for no
right,
offense.
we're
No
on the
offense, I'm not doing this for y'all. So I already know what candlesticks are. I know what a trend is. I know how to see the trend. You feel me? I know breaking structure, but I am gonna rewatch the breaking structure part where he explains it again. I am gonna watch this one again. Breaking
An
structure.
award-winning trading app that is as easy to set up as your favorite playlist. Voted most
I am gonna watch the breaking structure one because now the breaking structure is still something pretty tricky a little bit to me because like it's kind of hard to. So pretty much how he explained it, the breaking structure is it would be so there's a trend going down, right? So the second a candlestick break goes in the opposite direction and not the snail trail that it leaves, not the not the snail trail. I'm talking about like the full bar. Like I'm talking about um 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 like motherfucker, hurry up. Why the fuck is it third? Ooh, bitch, bitch, bitch. Continuous JPS. Get login. So got it. So pretty much shit like. Oh yeah, I forgot I had a trade. Yeah, yeah, yeah. I forgot I had a trade going. You see this? So currently I'm up 5 bands. Currently I'm up 5 bands. My expectation is to hit it right here. I forgot about it. Yeah, I forgot I had a trade. This is paper trading, obviously. So currently, this is my realized paper PPPL, realized potential and losses right here. This is what I've earned so far. This is what I unrealized. So this is what I can take right now. I could take this right now. No, no Diddy, no Diddy. I could take this. One's so these are longs. I believe I put this trade in yesterday if I'm not mistaken. But I could leave with 5K right now. But I believe it's still gonna go up this high because look, it already did this. It already left this big boy right here. I believe it's gonna go up either a little bit more to fill more of this in. If not, it'll just and then I don't know where it'll go after that. But right now, I believe it'll still go there. So I'm not gonna. I forgot about it. So look, if I didn't forget about it, I could leave. I could leave with 5 bands right now. You feel me? But adding that to that, so that'd be what 17. That I would pretty much look. So look, I have two trades going on. So this one would be for 6K. I'd hit 6K on that one, and then this one I'd hit for 4K. So that'd be 10K. So now this is where the mindset thing would come in. Now, do I want to take this out right now? Take out 5K? Like I'd take out 5K combined from both of the trades, or continue with the confidence in your trade and possibly get 10K. You feel me? You feel me? You feel me? I forgot about it. So that kind of brought my vibe up. I ain't finna hold you. I ain't finna hold you, cuz. So I'm finna leave that there. But what I meant is, like, a breaking structure would be like, pretty much, see how this is going down? This is a downtrend. So pretty much the breaking structure would be, say, not, it wouldn't be, none of this would be the breaking structure. None of these up to this point will be the breaking structure, because the snail trail does not count. Like, it has to be a full body that would be breaking. So like, right, this would be the breaking structure because of it passed this, the highest point right here, and then the lowest point obviously is not. It started pretty much, it broke in structure because it started going up again. So that's what I believe the breaking structure would be. So just to, you feel me, just to give me a little bit of a refresher. I can't believe that shit, bro. It's almost at 6K. Bro, look, it's going up still. Oh shit, let me chill out. Let me shut the fuck up before it starts going down. uh, so if I do win that, I'd be at 23K. I'd get myself back up to 23, right? No, 10K. I'd be at 20. I'd get myself back to 28K, or if not, I would pass it. Oof.
Okay.
Oof. I'm feeling.
Unlock the world's largest, most liquid financial market with
And break of structure is very, very simple, but for some reason I get lots of questions on it, and in this video I will try and simplify this shit so literally a child can understand it, okay? I'm going to try and make this super simple. Okay, a break in structure to the upside, okay? And we'll show examples of this on the chart and through drawing, okay? A break of structure to the upside. So that means there is a downtrend currently, right? A break of structure to the upside is when we have a closure, a candle closure, not a wick, a candle closure above a high. Remember, what's a high? A move up, then a move down. So that means in order for it to break structure to the upside, we have to see a single candle close fully, meaning closing above this high.
My fault. I'm not even on this page. I just wanted to see, like, what was up. And then I remember the reason I took this trade is because all of these lined up right here. This one went all the way down here, but yeah, it closed all the way up here. Like, it opened right here, but closed right here, and it went all the way down here. And then all of this just scattered down here. This shit came down here as well. These bad boys came down here, went up, came down here, went up, came down here, went up. Once I seen that it was like, I took the trade right here. Once I seen that this shit was going back up, and I seen this low right here, I'm like, yeah, it's guaranteed for the. So I said, boom, I'm for the trade, because I'm for to put in a trade, put it in, and then yeah, that's where we at. So that's where I'm hoping it goes. Feel me? But these little wicks are like kind of worrying me, because it went up here and now it's down here. I'm still on the 45, and this is the 45-minute one. Feel me? This is 45 minutes. So I don't know. I might just exit out. Yeah, I might just exit out. I'll take that $5,000 win. So I'll take that $5,000 win. Okay, so there we go. Cheap viewers on streambo.com. Remove the space. Man, fuck all that. But that's not, pretty much that's not what I'm gonna be doing. I want to have my wins. I'm minimum. If I'm gonna make a trade, I have to minimum get 500 out of each trade. Minimum 500. Boom. And then if I'm gonna put up a trade like that, minimum I don't mind losing would probably be like 300, 200, 250 to make me happy. You feel me? So that's probably how I'd be. I'd want to risk less and have a high rather have a lower risk and a higher reward. So oh, I got an itch. Ooh, I got an itch. Ooh. Alright, let me get back to me. Let me get back into me.
High, meaning the candle body has to be above the wick of the high. Make sense? Let's find an example on the chart, because I'm not sure this makes sense yet, because this is how I described the last video and we still had questions, but that's okay. Questions are good. I'm gonna try and help you guys understand this. Okay, so right here we get a move up, then a move down, then a move up. Okay, perfect. We made a low right here, and as you can see right here, we had like a miniature uptrend. Okay, we come down, get a move down, then a move up. We get another low. Cool. I no longer care about this previous low. I'm only caring about the most recent one. Okay, and we'll get into that a little bit later into this video. Okay, I only care about the most recent high or low that has been made. As you can see here, we previously had broke structure to the upside, right? Uptrend. Okay, then we have this low, and what happens, right? We have a move down, then a move up, but then, right, we weren't in a downtrend previously, but what happens with this candle?
Breaks the structure.
The body of the candle closed below the low. So what happened? What did it cause it to do? Started a downtrend, right? Boom, lower high, lower low, probably going up to form a lower high, or retracement on the weekly time frame to come up within here. Okay, so are we starting to understand what a break of structure is? Now let's try and find a break of structure to the upside.
Yes. Oops.
This is just lovely, right? What happens? We were previously trending up. This gives us two perfect examples of this. Previously trending to the upside, right? We see a low. What happened to the low? The body of the candle closed below it. What happened to the trend? It shifted, right? We have a high right here. We have a low right here. Where's the next high? Right here. Where's the next low? Right here. Lower low, lower low, lower high. What's this right here? A move down, then a move up. That's a low. What's this right here? Move up, then a move down. That's a high. What's this? A lower high, a lower low? Wow, would you look at that? It's a trend. It's a downtrend because market structure broke. Okay? So now that we're in a downtrend, what happens over here? We have a high right here, and you're going to say, oh yeah, it broke. Whoa, whoa, whoa. Slow down. We also had a high right here. Why? Why is this a high, guys? Why is it a high? Because we have a move up and then a move down. We get a closure above it, okay? The candle closed above the wick, and then what happens? Bing bong, moves to the upside. We make another high right here. Why is this? TJR, why are we using the wick of this? Because up candle and a down candle. How do we mark our highs? The highest point of those two candles. All right, the wick, right there. We got it? We closed above that. Yes, we closed above both of these yet again. However, we don't care about this high anymore. Okay, there will be times when price will consolidate, right? Not within a trend, right? It'll just be consolidating, and you'll see a lot of.
And that's what I call break of structure. So pretty much my understanding of breaking structure is pretty much what he said. So it's 100% aligned, and I'm not gonna say I 100% understand it, but I'm 90% understanding of what he is talking about and how to spot it, and we can do that on the chart right now. So like right here, we could lower that. Here, we're on the 45-minute time frame. So this would obviously this is up. Boom. This is down. We got another up right here. It sounds so unconfident. So these are all. This is all the downtrend. High, low, high, low. Obviously, they're not all supposed to be like into like that, but like if I look going deeper, it'd pretty much be the same thing. Like high, low, high, low, high, low, high, low. But we only care about the most recent highs. So high, low. So it'd be a little high. And we got like a low right here. We got a high. I mean, it's more be in line. So yeah, this wouldn't count as one. So it'd be high. And then down here, we got our low. You feel me? So yeah, I understand the highs and lows. Bam, 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 bam. Yeah. I made money from here to here. Or monopoly money. In both those senses. Yes, I did. Yes, I did. So that heck yeah. And I said I was going to read as well. So I'm gonna I am not a good reader in my opinion. Like I stutter a lot when I read, like a little kid type shit. Let me look at this right here. So I am going to read like 2, maybe 3 pages of this book. Meditations, the Diary of Marcus Aurelius. The main reason I wanted to get this book is because I saw it could help you become more disciplined, and Marcus Aurelius was like somebody with very strong with a strong
orders,
discipline.
Meaning getting people out of a trade. It can also be limit orders, like a buy limit or a sell limit. Okay, meaning when these price targets get hit, it's activating something. Okay, it's either taking you out of the market or it's entering you into the market. Okay, that's pretty much what liquidity is, right? It's a pool of money, right? And when it's a price point where when that price point gets achieved, people are going to be entering the market and exiting the market. Meaning there's a lot of liquidity, there's a lot of money getting cycled through the market during this point in time. Okay? So, with that being said, all right, why would we want to target these areas? Okay. Also, I feel bad for my gardener because Boogie doesn't have. Damn, I feel hella bad. I don't have dog bags for him yet, and bro has to like pick up all of Boogie's shit, and he just walked past me. Anyways, let's keep talking. Okay, so. Right, that's what liquidity is. Why is that it's so important?
This is a card.
Well, with that in mind, right, and then also understanding that banks, hedge funds, or not hedge funds, banks, institutions, okay, these market movers, right, the people that are actually causing the market to move, they have these massive orders, okay? So think about it, right? Think about a stock exchange. When I buy 1 share of Apple, that means somebody is selling me 1 share of Apple. We don't see it, but back in the day, right, people used to say, I would like 1 share of Apple, and then someone would have to sell that to him, okay, send them the paperwork so he, down here, right, I have a share, when a low gets taken out, odds are the trend will continue, okay? So,
I'm low-key locked the fuck in, I ain't for to hold you.
Trend session, or a trend video, trends don't last forever, right? So that's why when we use liquidity, we're able to catch the top of a downtrend or the bottom of an uptrend because we are literally getting into the market. Hold up. I got my friends talking outside, so I gotta mute them out. But we are literally getting into the market.
I don't want to hear him. Why don't you
beginning of
close your
trend, and
fucking
that's why
door,
we're able to
bitch?
catch
My
these
bad.
big moves. Okay. So when we see that happening, okay, we take note of it. Okay, so we know that underneath lows there's going to be sell stops, and then again, on the contrary, the people that are trying to catch a buy on this like mini little move up, their stop loss is going to be underneath the low. So right when that low gets taken out, okay, in a downtrend, people are getting liquidated. People are also going short, taking sell positions here, and then that gives market the opportunity to fill orders within here. Order block. We'll talk about that later, right? Right? This whole thing would be essentially an order block. I don't want to get you guys confused, but right, this move down here is what causes the liquidation and then allows market to fill those orders. Okay, so let's go into the chart and actually show examples of this now. And it's very, very easy. Literally jumps off the page. Look. Okay, uptrend. What's this? High. Boom. Sweep. Downtrend. Okay, we're not gonna get too analytical with it, and guys, this happens on every single time frame. Okay, right? Uptrend, sweep of the highs, collapse. Okay, this happens on every single time frame. Every single time frame. Ready? Let's go to the daily. Let's go on the S&P. There's great examples of this on the S&P 500. What's this right here? This is on the daily time frame, guys. We have highs right here. Boom, push up, takes out liquidity, big sell off. What's this right here? We have highs right here. Boom, market pushes up, big sell off. Dude, it's so easy, man. It's very, very easy, and it's you're going to be able to see this on every single time frame. And so that's also what your homework's going to be. Is literally just finding these situations where a high or low, a high or a low in whatever trend it's in, gets taken out, and then price rallies. Look, okay, ready? Want to see something crazy? Look at this, low, low. You're probably saying, oh no, it's just going down. Wait a second, go to the monthly, sweep. Liquidity got taken out. If we go to the yearly time frame, that is a massive liquidity sweep, right? What's market probably going to do? Probably going to reverse. And that also coincides with the US dollar being extremely weak right now. It's actually amazing how these markets move and how these markets work. Ready? And again, I don't want to get too deep into strategy, but this doesn't only happen on these high time frames. It happens on literally every single time frame ever. Okay, so if we go on to like find where market opens, or let's actually do it on like GU. Let's find let's find like, boom. Okay, this is Asian session. Okay, I don't want to get too deep into this because this is again, we just want to talk about liquidity and be able to spot it within the market. But as we can see, right, we have a mini downtrend, right? We break structure to the downside, take out these lows, rally. We break structure back to the upside, price pushes higher. Okay. Like we could find this type of shit on the 15-minute as well. Okay, and when you guys get good at it, when you guys get good at like spotting this, it should be like super easy to see and understand where this happens, right? It should just jump off the page. Boom, sweep, fall. Boom, sweep, fall. Let's try and find some to the upside. And the reason why I love this is literally, boom, sweep, rally. Dude, Like, when you guys start to see this stuff, like, it literally jumps off the page. Sweep, rally. And then what does it do to the upside? Sweep, fall. It's how the market moves, you guys. The market is unable to actually move in the direction that it wants to without taking out liquidity to fill the orders. Okay, this is why I love the way that I trade, because it literally makes sense. You are not playing off of a floor getting bounced off of, or it's touching the ceiling, so it's going to go down. No, we're actually understanding why the market is moving and when it wants to move in whatever direction. Like, this is literally going to be your homework. I don't really have much else to say on this video.
There's one right here. So, motherfucker, where would it be at? Right here. Bam. So, reached over and went up. That's one. Let's see. Okay, right here. Here's another one. Right here, even right here too. This little one right here. Boop, 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 boop. But I'm gonna just do it from here. Just the line right here. Boom. It went over and then it dropped. And then here's another one. Right here. So this one dropped below, boom, and then it shot straight up. Here's another one right here. Boom. Boom, passed, dropped. There's another one right here, boom. Right there. Welcome. Hi, welcome back to another video. My name is JPSMMT and welcome to it. Hi, welcome back to Unstuck. I am Cito. And welcome back to another video. Well, not another video, this is just another part. I believe this is day 3, of continuing and streaming while I learn trades. Yeah. We took a trade yesterday. It was an unfortunate one. So pretty much we had I believe in the last clip it has the last trade that I had yesterday too. It was pretty much I started it here to go down and I had my take profit literally right here. And then I had my stop loss. I should have had my stop loss higher for real. I should have put it higher, but I had it right here. My fault, I had it right here. And it ended up coming back and it closed it out. And then it ended up going in the direction that I wanted it to go. So, yeah. If I would have hit that, it would have been like, I think like 2, a little bit over 2 or 3. So, yeah. But it's okay. It's a part of life. My stop losses was total about a band. So I lost just a band. That's it. Here. Should be right here. So yeah, yesterday I lost 864 plus 849. So a little bit over 16 is what I lost. But the day prior I made that and that. So 5 something. So okay. You feel me? But we are going back. We are on boot camp day 10. But we're on liquidity part 2. So we're gonna get right into it.
I think day 10. So you guys know that last day that we talked about trading, we were talking about liquidity, just kind of what it is and why we would want to use it in the market. So this is liquidity part 2, okay? And this is just going to be how to spot it in the market and where it lies within the market. And then finally, right, I want to take it like one step at a time so you guys can like have time to process and like understand what's going on. And then after all that goes down, then we will be able to get into how we can actually take trades off of it. And then if that doesn't make sense, don't worry, because we will have way more time to discuss strategy and actually executing on trades once we start learning more things. Okay, so today we were going to just talk about where it lies and then pairing that with, why we want to know where it's at and also understanding it. And then from there, like it should be kind of self-explanatory as to how to take the trades, but we'll still discuss that in 2 days. So
Unlock the world's largest, most liquid financial market with Forex.com. Forex or FX.
right,
Forex
let's
or
look at a
FX.
little overview of what we talked about why we want to use liquidity. Number one, that's where orders are going to be filled, right? That's where the banks.
Did you get a notification that I went live?
Market, that's where they're going to fill their orders and actually push market whatever direction they would like to. Okay. And then again, how do they get these orders to be filled? They have to have people exiting the market.
No,
They
you're
also
cool.
have to have people going in the opposite direction of them, right? Just like 2 days ago. It's an exchange. If they need to fill millions of orders, they need millions of orders going in the opposite direction. So that leads us into today's video talking about where liquidity lies. So where are all those people going to be going in the opposite direction of the banks and institutions? Okay, where and who's stupid enough to do this? Where is it happening? When is it happening? All that good stuff. Okay, so let's just talk about basics. Remember, when we talked about trends, how do trends move? Higher highs, higher lows, lower highs, lower lows. So it's safe to assume that traders, like retail traders, will see, higher high, higher low, higher high, higher low. They see that it's trending, right? And they know that the trend is continuing when the high gets pushed above, right? Confirming that there's going to be a higher high, right? So what most retail traders will do is they see, higher high, higher low. They see that the high gets pushed above. They either have buy stops, which is literally just pending orders right above the high. So, right, the price point would be like right above here. And when that gets hit, boom, order gets executed, they get filled, okay? And they're assuming that price is going to continue in that trend, okay? Now, on the contrary, there's also stop loss orders right above these highs as well, right? Because there's people that are trying to short this down move, which isn't necessarily smart, right? You want to trade with the trend, which is what the people that are buying up here are trying to do. But there's also people who are shorting within here, right? And if we know, right, same thought process, right? When people are shorting, they know that their idea will be invalidated if price pushes above this high, right? So they would be exiting the market if this price point gets hit. Okay, hopefully you're starting to understand and see what I'm trying to get at with this is that when this high gets hit, when this high gets pushed above, people are getting out of the market and people are getting into the market, which is essentially creating liquidity for the potential for these banks and institutions to fill their orders to change market direction. And you're probably saying, well, TJ, we can think of liquidity essentially as a magnet for price. That is where price is drawing to, because that is where the market makers want to push price so they can get their orders filled. Make sense? Cool. Right? So any form of liquidity, right, consider it a magnet for price, right? We're not considering it, buy, sell. We're saying, okay, this is an area where orders could get filled for us to potentially take a trade. It doesn't mean when this high gets hit, we press sell. It doesn't mean when these lows get hit, and press buy, right? Because if you did that, you lose way more than you win, right? We wait for these areas of liquidity to get hit, and then we wait for confirmation through break of structure, through other confluences, right? That we'll talk about later in this. Okay, we wait for those confluences to give us the confirmation that liquidity has been swept and that orders have been filled. That makes sense, right? So when we see a liquidity sweep, when we see these prominent highs and lows get taken out, it's safe to assume, okay, I'm now going to wait for confirmation that orders have been filled, because then price is going to go in the opposite direction. That makes sense? Cool. Okay, and that's all liquidity is. So how can we use this to our advantage for entries? Well, I just talked about it, right? We wait for those prices to get hit, and then we see what price reacts off. If price doesn't react, perfect, no trade. If price does react, perfect, act on it, take a trade. Right? And then, on the contrary, how can we use liquidity for take profits? Right? If it's a magnet for price above, right? If we think, okay, yeah, highs will attract price because that's what it wants to seek out in order to go lower. If we're saying, oh yeah, this is a relative bear market right now, right? If we're saying, oh yeah, this is a relatively bear market, I think price will go lower, right? Then we're waiting for highs to get taken out. But then, right, let's say we do find a trade. Let's say we're able to find an entry, whatever, here. Where are we going to target, right? If we think price is going to go lower, if liquidity is a magnet, then it's probably going to start seeking out these lows. Why? Because just like how market makers need you guys to be entering and exiting for them to enter orders, it's the same thing with exiting, right? Because if they exit at a random point in the chart, right, without a low or a high being like an area where they take orders out, right? If they were to just, exit right now, right, price would probably drop, price would move in the other direction. They still need people entering and exiting the market just like they do to fill their orders, to sell their orders, right, to exit their orders, to exit their position, right, without price just making a big move after those positions get closed out. Does that make sense?
So you heard the man. I gotta look for some liquidity sweeps, and I gotta find out like the actions before it to make myself more confident in being able to set trades after I see it. Here, I'm gonna just go far back. Or, actually, I'm gonna just click on a different one. Just a different one, just to see what's popping. Yeah, I'll go to the S&P 500. I'll do it on that one because I don't even trade on that one. I can't even trade on that. I can't paper trade with S&P 500 anyway. So, okay. Why is it missing pieces like this? I mean, I don't think. Huh? I know. I don't know if it's lagging or if it's just like the market, but I believe I may have found a one right here. Oop, I didn't mean to put it right there. Yeah, right here. But I can't see what this, I'm assuming this is just, it went straight down. Or the market stopped right here and then it opened down here, but that yeah. So I might just say yeah because so where would be the break in structure? So should be all of this right here. They passed over the high just a little bit. We got these long ones, breaking structure right there, and then it proceeded to go down. I don't know if there's any more like if there's like a low ass bar right here, but this could also be another one right here. Even if it's right there, I'll just put it right there, cause why not? It went down. Where would be the break in the structure? So it'd be like right here. It'd be this. This would be the break in the structure. Cause it closed above it. Closed above this snail trail, and then it proceeded to go up. Am I heard? Good morning, everybody. My name, good morning, everybody. This is Unstuck, and my name is Cito. It is, I believe, day 4. It is currently 10:34. I'm about to watch TJR's bootcamp video for the morning portion. Do whatever homework, and then I'm gonna do some old homework too, so I could just get more experience on finding liquidity sweeps and how finding the process on how that happened as well. And then finding the process before it leads to a switch in direction or into a different trend. And what I mean by that is, like, I'll find like how TJR said, find a fair value gap, find the breaking structure, find if there's like a liquidity. Obviously, I was looking for liquidity sweep, so I found that. Find any fair value gaps, any breaking structures, and then see if it switches. And then if that switches to the other side, see, like, if it switches the trend, then see how all the changes that happened before it switched that trend, so I can see it more easily. And then when it comes time for me to take a trade, I could use all of those skills that I was practicing to actually take a trade that I'm 100% or 90% comfortable doing. So, yeah. Like yesterday here. This is my screen. So yesterday, I didn't take a trade at all. I did, and I took a trade for the day prior, and then it closed out the other day. It would have been from here to here, but so far it's just been. So I didn't take anything else after that. I've been waiting for this to either go below this or break its structure to the upside, because right now it's on a downtrend. Like, this looks like head and shoulders, head, shoulders. But also I had this pretty much like that, and none of this was here. And I also, because I wanted to see if it would create a fair, if it would be the start of a liquidity sweep, because of passing, like, it going past the lower low for a couple of clicks and then reversing to the other side, aka the liquidity sweep. Thought that was gonna happen, so I put it here. It did end up passing, so I still got some time just in case to see what happens before I put in a trade. If there is one, I'm gonna wait for the breaking structure, which means like it'd have to pass like here or here. So yeah, if I don't see any movement into the trade that I believe is gonna take, then I'm not gonna take that trade today either. Bet until all that shit moves. We're gonna start off with rewatching the liquidity sweep part 3, and then we're gonna go to the fair value gaps. Or we're also gonna watch the risk management. Just to get a little bit of a refresher from yesterday.
Most liquid financial market with Forex.
What's good, guys? Welcome to boot camp. Who knows what day, but all I know is we are talking about wrapping up our liquidity little lesson, little series within this boot camp. So after what we have learned, also, guys, look, pretty little microphone. I'm spending money on you guys. I didn't need this. I was fine with my trash ass setup, but guess what? I was getting shit on when all you guys were saying your face cam is ass. Your setup is ass. Dude, come on, bro. I used to just trade on my phone. You guys are trying to make me up my shit. But anyways, today is part 3 of our liquidity series, and then we will move from there over to our fair value gap series, and then over to our order block series, and then over to our equilibrium series. So we're starting to add the building blocks that we
Hell
need to
yeah, we
actually
starting to
get
add the
trading.
building blocks. You heard what the fuck he said?
That's going to be part of what we're doing today. Pretty much just talking about the full overview of liquidity, seeing how we can use it to our advantage, really, because now, right after the first day, we understand what it is and why we want to use it. Right after the second day, we can see directly how it works on the charts, right? We can see, okay, a high gets taken out, and then what happens, right? You can see orders get filled through break of structure, through market structure shift, whatever you want to say, and then price changes direction. So that's more of what we're going to be doing today, literally just spotting it out on the chart, helping you guys be able to spot it easier, and then translate that into how you could potentially take a trade off of it. Again, I don't want you guys to think this is a strategy. It's not. It's a piece that we can plug in to a strategy, okay? This is not end all be all, okay? So, I mean, literally just starting off, I don't know if you guys can see this, but pretty fucking obvious. We see boom, leg down, break of structure up, closing all the way up here, price rallies, okay? It's closing all the way up here, boom, leg down, break of structure up, closing all the way up here, price rallies, okay? It's very, very easy to see this on the chart. It's when
But I said that was the
in
breaking structure.
action,
That's what I was pointing at.
Can you
My
actually
mic was
see
muted.
it, and can you
Fucking
react
nigga.
and actually take the trade correctly off of it? And that's what we're going to be, trying to help you guys do. Let's get rid of my trade from this morning. Schmink. Get rid of this trade that I didn't take. Get rid of anything on here. Cool. All right, so, oops, what the fuck? All right, so to start off, we will cover liquidity on the S&P 500, just because it's pretty easy to spot on high time frames, and it's really relatively easy to show how you could potentially take a trade off of this and how it works. Okay, so first of all, right, why do we want to use liquidity, right? Just a little recap, because that is where the market makers are able to fill their orders, right? Because there's a bunch of people exiting the market and there's a bunch of people entering the market, okay? Perfect. There's a lot of money getting transacted through the market versus when liquidity isn't getting swept or getting, induced, then, it's kind of chippy choppy, okay? Ticky tacky, okay? They aren't able to completely, change direction of the market. All right, so what we're looking for, right, is highs and lows within the market, right? Because that's where people are going to be entering long, and that's where people are going to be entering short, and then that's also where people are going to be getting stopped out, right? So with that being said, right, we are technically looking to label highs and lows as liquidity, right? And most importantly, prominent highs and lows. Okay, so you're probably saying, well, how do we know what's prominent? Well, it varies from time frame to time frame on what is prominent or not. But if you just look at the chart, okay, it's relatively easy to just mark out what highs are prominent and what lows are prominent. This is getting kind of messy. I'm just going to work with what we put on right now. So, as we can see, prominent high right here. Why? Because it's the start of this big trend. Okay? We come down, we come up and make a double top, pretty prominent high. We come down, make a lower low. Okay? Then we come up and take out this prominent high, making a new prominent high, and then what does market do? Rally even lower. Okay, boom, we can get rid of these lows. Okay, then what does price do? We make a relatively prominent low right here, and then a relatively prominent high right here. You can argue that these are prominent highs, but you know, whatever. Relative prominent high right here, relative prominent low right here. Obviously, we push lower because this is a downtrend. Okay, what does price do? Come up, takes out this high, right? What happens? Breaks structure to the downside, price falls. Now we have this as a prominent high.
Why you turn?
And this as a prominent low. Okay, price comes down, makes a lower low. Okay, I would also consider this a prominent high because it broke structure on the daily time frame. Okay, what happens? Price rallies up, takes out the prominent high, comes down a little bit. Okay, now we've pushed past that. Where is price likely going to draw towards? This high, right? We can think of liquidity essentially as a magnet for price. That is where price is drawing to because that is where the market makers want to push price so they can get their orders filled. Make sense? Cool.
Yes, sir.
Right?
Like
So any form of liquidity, right, consider it a magnet for price, right? We're not considering it, oh, buy, oh, sell. We're saying, okay, this is an area where orders could get filled for us to potentially take a trade. It doesn't mean when this high gets hit, we press sell. It doesn't mean when these lows get hit, and press buy, right? Because if you did that, you would lose way more than you win, right? We wait for these areas of liquidity to get hit, and then we wait for confirmation through break of structure, through other confluences.
Motherfucker said one.
Right? That we'll talk about later in this.
Yes, sir.
Okay, we wait for those confluences to give us the confirmation that liquidity has been swept and that orders have been filled. That makes sense, right? So when we see a liquidity sweep, when we see these prominent highs and lows get taken out, it's safe to assume, okay, I'm now going to wait for confirmation that orders have been filled because then price is going to go in the opposite direction. That makes sense? Cool. Okay, and that's all liquidity is. So how can we use this to our advantage for entries? Well, I just talked about it, right? We wait for those prices to get hit, and then we see what price reacts off of it. If price doesn't react, perfect, no trade. If price does react, perfect, act on it, take a trade, right? And then, on the contrary, how can we use liquidity for take profits, right? If it's a magnet for price above, right? If we think, okay, yeah, highs will attract price because that's what it wants to seek out in order to go lower. If we're saying, oh yeah, this is a relative bear market right now, right? If we're saying, oh yeah, this is a relatively bear market, I think price will go lower, right? Then we're waiting for highs to get taken out. But then, right, when let's say we do find a trade, let's say we're able to find an entry, whatever, here. Where are we going to target, right? If we think price is going to go lower,
we're going for
if
the
liquidity
lowers,
is a magnet,
the lower lows,
then it's probably going to start seeking out these lows. Why? Because just like how market makers need you guys to be entering and exiting for them to enter orders, it's the same thing with exiting, right? Because if they exit at a random point in the chart, right, without a low or a high being like an area where they take orders out, right? If they were to just, exit right now.
On this one that I'd be waiting for it, so I'm gonna just. This is just like a little sign, so I'm gonna leave it there. Oh shit! This is a little one right here. No, it's not. Cause the snail trails count. Oh. Not mean to put that bad boy there. stopped. Put on my lows. I believe this is one right here as well. Ooh. Right there. Damn. It went down and made it past this lower low. Then it also went down as low as this lower low. It came back up, it took out this high as well. Did it go up? It may even be a little more here too. Kablowski. And I'm in a 45-minute time frame. So if I go down to the 5-minute, yup, you see this shit? Yup. Swept it. And then went down. Boom, the breaking structure. Who's this bad boy right here, ain't it? Yup. 100% breaking structure right there. Whoa. Damn, I wanted this. I could do this one too. Man. We'll go back to 45-minute. 23. All of these are permanent lows that got took out by this. This low got taken out. This low got taken out. This one got taken out. These ones did not get touched. Now you're either gonna pass these ones or start going back up. I'm hoping it starts to go the fuck back up. But if not, it is what it is. Cause it's not gonna go down forever. It's been going down. I mean, there was a little up spikes, yes, little up spikes. So, but it's been on this somewhat downtrend since well, it really started all the way here, which is since Monday, October 25th. That's when it really started to go down for real. Yeah, right here, there's a prominent, there's one right here too. And if I'm not mistaken, if I go into maybe 5 minutes, I can show it even more clearly. Show, we got another foul. Come on, foul. Alrighty. Now it's time for risk management.
Download our award-winning mobile app and start trading on the move. Introducing a crypto and FX trading.
What is good, guys? Welcome back. Welcome to boot camp, I believe, day 13. Hopefully you guys are ready to get into some discipline stuff. And for most of you guys, today is going to be relatively easy. For others, you know, you might be able to learn a little bit more. But today we are going to talk about something very basic, which is just risk management, and really the first part about risk management in just trading back to you. You just got to do the right stuff and don't slip up. Okay, so today it's going to be a relatively quick video, but it is very important if you don't know anything about it. And like I said, all over TikTok, and like I've said at the beginning, we are doing this from scratch. So this is essential for me to mention, especially because I feel like a lot of you guys come into this thinking you are going to make 100K in your first year. I hate to ruin your dreams. I hate to break it to you, bro. You're not gonna make shit. You're going to lose money probably in your first year, probably in your second year. Imagine this is like college tuition. You're paying for the lessons. Okay? So how can we make it so we lose the least amount of money? Because it's kind of impossible to just start off offer, even if you've been trading on demo, even if you go from demo, profitable on demo, to live, there is going to be an in-between where you are losing money. Just because your emotions, it's so hard, and that's why half of this literal boot camp is all dedicated to emotions. So hopefully we can start nipping those things in the ass and, cut out a lot of these problems that you'll face along the way, as long as you guys listen, as long as you listen. Okay, so today, what are we talking about? We're talking about risk management, how much you should risk per trade, and that's about it, and how often you should trade, because that's really all risk management is, right? What are we doing? Managing our risk. How do we do that? Understand what we're risking and understand not to overdo it, okay? So how can we do that? What I like to do, very simple, okay? Risk 1 to 3% of your account. And that's it, okay? You're risking 1 to 3% of your account size per trade, okay? And depending on if you do futures, if you do options, if you do Forex, there's a bunch of different ways to calculate this and figure out your risk. And it's relatively easy on all of them. And a little simple Google search can help you out. How do I risk 1% of my account doing options with this stop loss? How do I risk 1 to 3% of my account doing futures with a 2-point stop loss, with a 5-point stop loss, with a 10-point stop loss, right? How do I calculate, how do I figure out 1% risk on this account size with this pip stop loss for Forex, for example? Okay, simple Google search, or literally just looking up lot size calculator, position size calculator, all of those things work. That's not for me to do. That's for you to do. That's your homework. There you go. That's one step of your homework. Okay. You can figure out where you can find out to calculate that. That's not what I'm here for. Google can do that in 2 seconds, and I'm not going to waste my time explaining that. So that being said, you're going to risk 1 to 3% of your account. Why are we doing this? Well, let's think about it logically, right? If we are risking 1% of our account per trade, that means we would have to lose 100 trades in a row to lose that account completely. Will that happen? Rarely, right? You may be asset trading, but you will probably get at least like 2 out of your 10 trades to hit take profit, whether it's from luck or just, it'll probably be from luck if you're terrible at trading, right? Right, it's pretty much impossible to blow your account risking 1% per trade, because that pretty much means you would have to lose 100 trades in a row, and you aren't going to do that. And then from there, it's like, okay, let's say let's say you're losing 80% of the time. If you're only risking 1%, then at the end of the year, you'll still have 20% of that account left, and that's still money that you saved, right? Instead of blowing all of it in 2 weeks and then having to refund it, right? So let's think about this logically. Would you rather be able to keep the initial account that you started with, or would you rather keep having to fund that same amount of money that's in your account right now every fucking week because you keep losing it? All because you want to get rich quick, and we know damn well you aren't, right? We talked about this at the very beginning. You will not get rich quick doing this. Get that fucking out of your head.
Okay, get it out of your head. And once that's gone, say, okay, cool. I'll get rich slow, relatively slow, right? So I'll get rich slow. How do you do that? By risking 1 to 3% of your account. Okay. What else does this mean? This also means, okay, yeah, we're risking 1% per trade. That means it takes 100 trades for us, to lose everything. However, what happens if you take 100 trades in a day? That means that account will be gone in a day. And we can't risk that. We can't. This is a risk on marketplace. This is a risk on asset. This is a risk on job. Okay? If you are the type of person that needs instant gratification and you need it every second of the day, this is not for you. Because with trading, trading is not what people paint it out to be. Trading is waking up and doing something without emotion, and you have to be able to make up to upwards of 60K in a day and be emotionless, and also lose, up to like 20. I lost like 27K like 2 weeks ago in one trade in a day. And you have to be emotionless, because the second your emotions plug in, boom, you're fucked. That account, consider that gone. Literally consider it gone. The second you start over trading, the second you start taking more than the set amount of trades that you wanted to take per day.
Have you ever wondered how the world's currencies are traded? The foreign exchange market, also known as the forex market, is the largest.
The minute you start doing more than that, that's when you're screwed. The minute you start risking more, that's when you're screwed. And you're probably thinking, no, that's not going to be me. It's different settings. I don't know. Hopefully it worked out. If not, I'm sorry. But anyways, I'll see you guys tomorrow. Peace out.
I want to eat your ass and lick your ballsack.
He just said he wants to eat my ass and lick my ball sack. That's my teacher right there. That's my teacher right there.
Alright, this is attempt number 2 to make this video. We are currently in Miami right now, and I recorded this.
This audio sounds so ass.
But my computer overheated, so this is going to be take 2 and probably a sloppier version of it. But what's good, Jits? Welcome to fucking boot camp day. I don't even know.
Hi, Nancy. How are you?
15, maybe 4. I have no clue what day it is. But yeah, we're in this shit. I think we tapped at we've tapped 2 weeks now, right? But anyways, today we're talking about fair value gaps, liquidity voids, imbalances, whatever you guys want to call them in the market. And most of the time we would do this on like a little chart, but as you guys know how we've been setting like this whole shit up for this boot camp, I'm pretty much going to split up all those little building blocks into 3 separate videos, just so you guys have like a chance to take everything in and like actually properly understand the shit. So today it's literally just going to be one-on-one, me explaining what fair value gaps are, why we want to use them, how we can understand them in the market, to actually be confident in taking a trade based off of it. Because for me, I would much rather have take a trade based off of actual like market confluence and orders being filled and actually seeing that, versus it bounced off a floor or like it hit a ceiling, so it's going to go down. Like, are we being dead ass about that off of a drawing that you put on a chart? I have no hate towards support and resistance traders. It just doesn't make sense to me why you would essentially bet on something like that. But I mean, hey, some people make money doing it. This just makes more sense to me. It makes me feel safer about putting money into the market. So with that being said, let's get into fair value gaps, part fucking 1, boys. So what is a fair value gap? What's a liquidity void? What's an imbalance? It's literally all of those are pretty much the same thing. So I like to call it just a liquidity void. So similar to how we talked about liquidity in those past 3 trading videos, that's where, orders are residing. That's where market wants to target to take out those orders, to execute those orders at this certain price point. This is quite literally the opposite. This is a void, a price range where there are no contradicting orders. So if we see a big move up, right? Why are we seeing that move up in the first place? Because there's no sell orders through that price range. That's the liquidity void. That's the imbalance. That's the fair value gap. Same thing to the downside, right? If we see a big drop to the downside with no like hesitation and it just dumps, right? That's a liquidity void. That's the imbalance. And why is it a liquidity void? Because there's literally no resting buy orders throughout that massive drop down. If there were resting buy orders, price would go down, pull up a little bit, go down a little bit more. Yes, maybe it's bearish, and it still closes bearish, but there's still resting buy orders. So this is what it helps us do. We can actually be able to spot where there is no liquidity on the market. And if we think about this logically, right, when we're within a trend and price obviously moves with higher highs and higher lows, where are those higher lows going to draw to? Where are those retracements going to draw to? You know, probably into those areas that where liquidity was not before, right? And then what's going to happen once we get into those areas? Market makers can execute their orders because they know, right, there is a emptiness of liquidity. They know that right when they place their orders within there, market's going to move in their direction. So how is this beneficial to us? How can we, we'll talk about how we can spot it in 2 days on the next trading video, but why is this beneficial to us? One, it helps us accurately kind of understand, okay, where does price want to draw to when it's retracing, right? Fair value gaps are used for retracements. I don't use fair value gaps for like entries necessarily. I use liquidity sweeps to understand where market's going, and then I use fair value gaps to kind of like
Hey traders, welcome back to the Trading View channel.
up, gang?
In this video, we're introducing our new AI indicator, which we
figure out where price maybe wants to draw to, or for like a secondary entry, and we'll go into all of that stuff once we get deeper into strategy. But this is super useful because we see price in an uptrend drawing back down, and we can find a liquidity void, and then we see a reaction off of that, or like a break of structure on a lower time frame. Boom, like why wouldn't you execute that? Because you know there's a lack of orders lying within there, you know the trend is going up, and if you see a break of structure on a smaller time frame after a fair value gap or an imbalance or a liquidity void getting filled on a larger time frame, why wouldn't you enter there? That's literally, you see, okay, prices in this range where there's a lack of liquidity for opposing orders, right? If we're in an uptrend, there's no sell orders laying within here, and then we see a break of market structure on a lower time frame, why wouldn't you execute? Right? Doesn't that make so much sense for you to execute on a trade like that versus, oh, price hit my fucking ceiling? Are we being dead ass right now? Like, let's use our brains, okay? So I mean, with that being said, that literally is what fair value gaps are. It's literally just a lack of orders within the market, and that's what causes the imbalance to be made. The big ass candle, right? You guys are, and we'll talk about how to spot them in 2 days, but when you guys like see them within the market, most of the time it's a big candle down. Why? Because there's literally no orders stopping it from dropping that far down. Same thing with the upside. There's no sell orders within there that's stopping it from pushing so high up. And then when price comes back into that range, right, it gives the market makers to, the opportunity to keep pushing price in the direction that they want to. And again, once we start getting all these pieces, it's like, I'm sure even after this video, you guys will start looking into that even more by just seeing, okay, we got liquidity sweep, break of structure, we see the trend starting to form, and then, okay, now I have a fair value gap. Oh, I notice it gets filled, smaller time frame, break of structure, boom, we're in, okay? And it's literally as simple as that. Like that, people really make trading a
Ooh. Let's see if it closes. If so pretty much, if it closes below these bad boys right here, like it closes like the full candlestick closes below, like that should mean it is going to continue going down. But I'm not gonna, if it like, I'd say here I'm setting an alarm right here. Bang 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 bang. Motherfucker. That alarm right there. For me, if it's a full bar, a full candlestick going past this, it's gonna continue going down, and I'll put a trade. But if it's not like a full candle and it's choppy, and it look like it's about to swing back, then I'm gonna set a trade. I'm not gonna set a trade until I see a break in structure. Um, but when he was talking about a full long ass candlestick, uh, he was talking about something like these, like that, like that, something like these, something like these, something like these. It's very noticeable in the higher time frames, like for OCs, like these, like these, like these, like these, like these. Ooh, like these. And it definitely got filled in. Ooh, like these right here. Bow, 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 bow. Full candlestick like that this long. Oh, big Willie. Oh, big Willie. Ooh, ooh. Slap right here. Hour. Since I didn't watch them yesterday, I'm gonna watch more than I should. So I'm gonna watch like probably like 4 videos. You feel me? 4 videos or so, something like that for the vibe out.
Name on it just by thinking about it. Meet Base 44, a complete AI creation.
What's good? Welcome to Boot Camp Day. Who fucking knows? Again in Miami, recording for you guys right before the FX Summit actually. So I'm gonna be chilling here for a little bit, getting ready for my day. All the other guys are out getting coffee. I already did that. First one up. First one up, first one up, last one to bed. After this, man, they ain't waking up as early as me. They ain't staying up as late as me. Anyways, let's get into it. Today we're talking about discipline, and pretty much most of today isn't going to be talking. It's going to be me kind of telling you to do shit, telling you to write down stuff. And it shouldn't be, today really shouldn't take long. It's really about identifying the problems that you know that you have, and then, finding solutions for them. So, with that being said, pull out your fucking notebooks, and if you don't have a notebook already, pull out your notes app, and then go drive to the store and get a notebook. That's part of your homework. Go grab a notebook. If that means you already failed fucking day 2's homework, which was to go get a notebook, or maybe that was even day 1's homework. So get a fucking notebook. So, we gotta get that fucking covered, okay? So, let's jump right into it, okay? We need to know how to identify our issues. Damn, look at all that frizz. We need to know how to identify our issues and then solve them. Because if we can identify them, that's one step in the right direction. But if we can't solve them, or if we can't make an attempt to fix them, then we're fucked, because we'll always have that issue for the rest of our life. Okay, so with that being said, you got your notebooks in front of you. To make this video, we are currently in Miami right now, and I recorded this.
Okay, let's watch this Fair Value.
What is good, guys? Welcome. I'm sorry for the late video. Hopefully some of you guys are still awake. If not, I'm sorry. This is coming to you guys late. I have had 0 hours of sleep. I'm in Miami, obviously, and I'm still going to keep my promise of uploading a video every single day. I wish I could take a nap right now, but I'm not going to let myself do that, because you guys have shit to learn, and that's what we're here for. So, with that being said, let's just jump right on into it, okay? I believe today, hold on, actually, I don't want to get this wrong. I believe today is Fair Value Gaps Part 2. Let me double check the YouTube channel for a second. Yes, let's go. Okay, today is Fair Value Gaps Part 2. Okay, so today we're going to be talking about how we can identify them, and then also, like showing how you could potentially take a trade, or really today's just going to be identifying, and then day 3 is going to be how you can take trades and how you can put it together with liquidity sweep, break of structure, bing bong boom. All that stuff. Today is literally just going to be identifying them, understanding what they're used for, doing a little bit recap of that. Should be relatively quick, should be relatively easy. So with that being said, let's jump right into it. So we'll first do a quick little summary. Also, please forgive me if I, mess up. Like I literally, I've gone almost like 48 hours with no sleep. And obviously my voice is gone, and I've been doing a bunch of stuff. So if I mess up, bear with me. Anyways, what was it? Yeah, let's jump right into it. Okay, so first we'll do a quick little recap. What are fair value gaps? What are liquidity voids? What are imbalances? It's literally where there is a lack of liquidity, meaning there are no resting orders in the opposite direction of wherever price wants to go. So with that being said, right, if price comes down into that liquidity void, into that imbalance, into that fair value gap where there are no resisting orders, and then we can place more orders, boom, market is going to move and market is going to react. Why? Because there was a lack of liquidity within that area. That gives us the opportunity and the ability to, move the market. I can't, dude. I'm sorry. Messing up, but we're focused. All right. So with that being said, right, we understand that, okay, fair value gaps are essentially a liquidity void within the market where market will probably draw to and then react off of, and that's essentially what it is. It's literally just an imbalance, a liquidity void. Price draws back down into that. Why? Because there's no resting sell orders, or there's no resting buy orders in the opposite direction of wherever price is trending, which in turn makes fair value gaps a retracement tool. Essentially, it helps you find trades off of retracements. And as we start getting deeper into this, we'll start explaining, all that shit about how you can, use these. But something to note, fair value gaps are not reversals. Fair value gaps are not used for reversals. So if we see market trending higher and higher, if we see market going higher, right, breaking higher highs and higher lows, if we see market doing that, we are looking for fair value gap. We are looking for bullish fair value gaps. Okay, and we'll talk about where to find them. But in this case, right, we're bullish. So what are we looking for? We're not looking for bearish fair value gaps to turn price around. We're looking for retracements into these bullish fair value gaps for reactions. Okay, and continuations. That's essentially what fair value gaps and equilibrium are used
For
for
reactions
and retracements. Okay, so with that being said, now let's talk about how we can identify them. Fair value gaps are essentially, or imbalances are essentially, a 3-candle pattern. The first candle, okay, which looks like this, schmink, okay, and then the second candle, which is the candle that creates the imbalance, essentially, will be like super full like this, and then the third candle, which looks a little something like this, okay, and a fair value gap looks something like this.
Introducing Iron Beam, a bright choice for futures trading. Iron Beam is an industry-leading broker catering to traders worldwide.
Okay, so what is the area of fair value? What is the area that has not been filled, right? That didn't have any, resistance, resting orders, right? We see this, right? And we'll show examples of this on the chart, but we see this candle, right? Massive up candle, right? And no resistance in between. And how do we know there's no, we're confirmed bullish now. Okay, we know that we're bullish. Okay, what is this? We have a massive candle with no, right? Look, this, no wicks filling this. So what does that make this? A fair value gap, right? There is a liquidity void. What does price do? Draw into it, chop, break structure, rally. Okay, perfect example of fair value gap getting used. Boom, bullish, right? Bullish fair value gap, rally. Okay, it's actually very easy to spot these in the market. You literally just look for, areas that do not have wicks covering it. So for this one, for example, this one, for example, we have boom, right? From a bearish fair value gap, we have it from the bottom of the first candle's wicks to the top of the third candle's wick, like this, right? We can see boom, bottom of this candle's wick to the top of this candle's wick. We see price come in, chop, fill, drop. Okay, right? How do we know it's going to be bearish? We had a break of structure right here, confirming a bearish bias. What?
Ooh, feeling laminated. Put it in your butt, grip, tip, shit. You rock shaded. Oh my bad. Is this the one? Is this the one that I just did? I'm not too sure. I'm on the 45 minute. I'll take trades off of 45 minutes through. But pretty much, I see the retracement. Oh no, yeah, I just did that one. I'm not tripping. I'm tripping. Yeah, I'll do it on the most recent one right here. This is right here. So pretty much, I can't really see. I don't really know where the lowest is. I see that this is missing, but this is probably just a long candlestick on the up, on the blue side right there. My fault. I got little fruit flies in here, bruh. But so I see this is the retracement area right here. This is a long candle. This is the great value, right here, or the fair value gap right here. So this is the 45 minutes. I see all of this. Once I see this big candlestick, because there's guaranteed either a big candlestick or a bunch of little ones. Once I see that it passes these highs right here, these little highs, you feel me? Once I see that it breaks, these highs right here, drops right, it's down here. It breaks this high, this high, this high, this high. How it did? Because it just hit a little retracement. I would figure it would also go down too. I mean, it would also go up here too. So from there, once I see that it passes all of these retracement, all of these higher highs, and it makes a new one, I still probably wouldn't, because I know from it coming from all the way from down here all the way up here, it's eventually gonna go back down. Before it probably touches this. So, and it does. It has a fat down retracement going down, boom, 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 but it comes back up, boom, 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 and it passes all these higher highs again, and then it comes back and it passes this higher high, and it fully takes this retracement right here. So once I see that it's all this jibble jabble right here, how this is, the market doesn't know where it wants to go. So, from seeing all of this and all of these retracements, my next opportunity, I'd guaranteed have a trade to the upside after seeing all these higher highs and then seeing this jibble jabble. Because I mean, it had a retracement here. It had a retracement to this. It passed this lower low, and it did not pass this lower low right here. And it shot up. But I would be worried. Like, I'd put this trade and I'd probably be scared and I'd probably exit out right here, or this would hit my stop loss. Honestly, it would hit my stop loss. But nevertheless, it has a retracement. So I'd put my trade right here. Once I see this jibble jabble and I see that it passes all of this and I see this jibble jabble, I'd put my trade right here. Once I see the break in structure, once I see that this beautiful baby, shit. Once I would have seen this, I probably would have put it for the down. No. Because it would have been the same thing as this. How I said it. Yeah. So I would put it for the up. Because yeah, so in this jibble jabble, after seeing all this, honestly, yeah, because this is the S&P 500, right? Currently right here, back in the same area. So honestly, but I'd take my trade in this area. But if I see this break instruction, now that I'm noticing, I'm trying to think how I think in my old ways. I'm thinking how I should think how I think now. So I'd take a trade right here, and honestly, I'd get forward and I'd take this. I'd take it from once I see I'd take this trade from once I see this, and I see this close, or I see this go past this, I'd take the trade. and then I'd collect from here to here. I'd collect from here to here, and then once I see all of these retracements, I'd stop. I'd like take all of this because I don't want it to just shoot right back up. So I'd take this little trade for sure, but once I see that it's going back up, and I see that it passes, I'd probably take another trade for sure from here to here because of the retracement, because of this great value area, and it did retrace. That's 2. But I don't like how choppy this is, so I'm gonna go to another one. Hooktown feeling. I'm wild, singing me, and you'll remember me. There we go. Okay, I'll keep it like that. Okay. So, me looking at this from the hourly, I'd be looking at this, and I see that this is not lower than this, but I'm looking right here. If I look at this is lower than it. This goes way below it right here. Hold on, what the fuck am I talking about? I'm talking about this great rally. I mean, nothing, hold on, it never got touched yet. Hasn't got touched yet. Oh, it hasn't gotten touched till over here. This did get touched, but not until over here. Same thing with all of these. Yeah. I'm on the hourly. Oh yeah, right here. I'd take a trade off of this one, for sure skis. If I were to see it, yeah, I'd see this fat uptrend. I'd wait. And then I'd wait until I see a beautiful candle like this, letting me know that the motion, what is it called? The momentum of this candlestick is slowing down because it went this high and ended up closing down here. You feel me? It opened here, went up this high and closed down here. You feel me? I see a red candle, hoping for the downside. I see a little up candle, but yet this up candle does not close past this high point. It doesn't even go close to the top. It doesn't even have a snail trail. It has a baby snail trail. This is you feel me? This is the hourly though. I see that there is a break-in structure right here, but even though once I see all of these red, I'd figure of a retracement, or I'd think of a retracement because you feel me. So I'd have to look on the lower time frame. So I'm gonna go to fuck. Here, let me go back to the hour, and then I'm gonna lock it in because, like, bro, what the fuck? It was this one right here. Boop, boop. Bam. Bam. 5 minutes. 5 minutes. 4 minutes. Where the fuck did you go, my boy? Where did you go? Why does it do that? Why did he do that? Why did he do that? Where is I at? Why can't I go back? That phone. Like right here.
Value gap section. I watched over the second video and it wasn't as bad as I thought it was. So we're going to leave that one there. And then honestly, this video, there isn't too much to cover besides kind of recapping what we talked about in the first 2 episodes. That's kind of what the third one is for, just a whole recap and then showing how we can put everything together with it. So I do think the second one was good enough, and we'll go a little bit more in detail today on how we can use fair value gaps. But hey, we know why we want to use fair value gaps. We know why they're beneficial in the market. We know why the market reacts off of them. And we also know how to spot them. Okay, so with that being said, today is pretty much just going to be a quick overview, okay, and then kind of putting it all together, how we can, actually use them to make money. And honestly, today's trade that we took was a perfect example of it. So let's jump right in, you guys. So to start off, okay, this is going to be uptrend on the S&P 500. We then proceed to break structure on the 15-minute, okay? And what do we get left with after this break of structure, right? We see a big imbalance within here. We see this fair value gap. Is there a fair value gap within here? No, because this wick overlaps with this one. Is there a fair value gap within here? No, because this wick overlaps with this one. This is the only fair value gap we saw, okay? Scaling down, where is market open? And we'll talk about the value that market open gives us later once we've covered all the building blocks. But we have market open right here. Wait, why is this not right?
My bad. I'm like, what the fuck?
Oh yeah, no, that was correct. We market open right here. Okay, so we saw that break of structure on the 15-minute, and then we see price start to rally back up into here. This is all during pre-market, okay? So we see a tap into there, a break of structure, it falls. But we're not even looking at this because we're fast asleep or at the gym waiting for market to open, okay? Because we're not going to take any trades that aren't off of market open, okay, or aren't after market open. Okay, so we see price come into this imbalance, this 15-minute imbalance. We see a break of structure here, okay, rally back up. Break of structure here now, okay, we come down, make a lower low than this one, okay, so we can kind of like confirm that, okay, maybe we're trending down now, okay, and then we see market open, and we see a push up into this, another imbalance. I'm literally just eyeballing this stuff, you know, seeing whatever I see. Right here, we get a 1 hour break of structure to the upside. Let's look at the high time frame. Okay, we're bullish because we had that daily break of structure to the upside up here. Okay, we see price drag on down, fill into this accumulation that caused the rally up. All right, and we'll talk about accumulation and distribution later in this course as well. Okay, so we see a break of structure to the upside. Okay, we see price coming back down. Okay, if we go to the 4. If we go to the 4 hour, we can see, boom, we have this imbalance right within here. We see price, boom, break structure, fall back down within here. We also have 1 hour imbalance right in here. And honestly, this is the one that I would prioritize due to the fact that we can see, hey, this 1 hour wick